Hey everyone, 3M reported fiscal 2023 first quarter earnings results on April 25th, and in this video I'm going to review those earnings results, look at the big picture financial critical metrics, and answer if this is an excellent time to buy 3M stock, if 3M is an excellent dividend stock to buy. Because if you haven't noticed already, 3M offers a very robust 5.8% dividend yield as of this recording. That's a nice return on your investment just from the dividend yield. But remember, when you invest in a dividend stock, you're exposed to two types of return. Number one being the dividend yield, but the other side is the potential for capital gains or decreases. So the stock price could increase or decrease, and those changes, the decrease could potentially be more than the dividend yield you're getting. So it's important to look at the stock's prospects to check out whether or not it's at risk of falling and eating away at your dividend yield. So that's what we'll do in this video. I'll answer if it's a good dividend stock to buy and if it's reasonable for investors to go ahead and start adding shares of this dividend stock. So in the most recent quarter, revenue came in at 8 billion, which was down 9% year over year. Adjusted earnings per share of $1.97 was down from $2.63 year over year. So revenue and profit wise, 3M is facing headwinds. Operating cash flow, however, increased by 26% to $1.3 billion. That tells me the company is experiencing many of its costs are non-cash expenses, one of them being write-downs because of this restructuring plan. The company announcing another round of cost cuts. This will result in 6,000 job cuts on top of the 2,500 job cuts it announced in January. 3M expects to save about $800 million annually from these cost cutting initiatives. The company reiterated its 2023 target of a 4% decrease in revenue and adjusted earnings per share of $8.75 at the midpoint, with operating cash flow coming in at $6 billion at the midpoint. So if we look at the target of 4% decrease in revenue year over year, that suggests the rest of the year is going to be better than the first quarter. The first quarter, the company experienced a 9% decrease in revenue. For the whole year, it expects to only experience a 4% decrease in revenue. That means for the whole year, it's going to average a 4% decrease in revenue, but on the first quarter, it was on pace at 9%. So that means the rest of the year looks better. The first quarter was the worst of it. The company took the band-aid off, ripped it off, and said, you know what, let's take all the pain right now, and that way we'll come out of the end of the year on a strong note. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. And then if you look at its valuation, 3M is trading at a price to earnings of 10.13. I have it down here. And this chart of its price to earnings ratio goes back all the way to 2013. And you could see this stock is the cheapest it has been in this entire 10-year period. So the stock is trading at the lowest price it's been in the last decade. Now, of course, that incorporates this bad news, right? The company's revenue is falling, earnings per share is down, and what I haven't mentioned yet in this video is the company is exposed to some legal risk right now. 3M is being sued, and if it loses that case, that could be an additional downside to the company's earnings per share. That could be a big outflow of cash to pay for that settlement. And so there is that risk included in this valuation. But if you look at it, it's trading at the cheapest valuation it has in the last decade. So you might ask yourself, how much of this bad news is already priced into the stock, trading at a price to earnings of 10, when the average over the last decade is about 17. But it's trading at 10. So looking at that, you can say to yourself, okay, some, if not all, of this bad news is already priced into the stock. Meanwhile, companies generating healthy cash flow, $6 billion expected for the year, and it's paying a robust dividend yield. So at 5.8%. And with the stock price as depressed as it already is, you can feel comfortable that much of that downside news is already into the price. So if you're a dividend stock investor and you're looking at high yield dividend stocks, 3M is one of the ones that I would consider buying. I would say 3M is an excellent dividend stock to buy right now, even amid these headwinds, because I feel that some, if not all of these headwinds are already priced into the valuation. Otherwise, you wouldn't be able to buy 3M stock at this price. If it wasn't going through what it's going through, you wouldn't be able to buy it at this price. And because of its long history of excellence, it's reasonable to be confident in the company's ability to come out of this intact, maybe not as strong as it was before, but maybe minimizing the hit, minimizing the downside, and coming out of it, returning to what it's good at doing. All right, so that's all I've got for this video. I hope you've enjoyed it, and I want to thank you for watching. I truly appreciate your viewership, and I hope you'll tune in again next time.